What wealthy retirees know about taxes that most people don't. Are you assuming your taxes will automatically drop in retirement? Well, you're not alone, but that assumption could cost you tens of thousands of dollars over time. See, most people think retirement is when they can finally stop worrying about taxes. But here's what the wealthy understand and why they often keep more of their money in retirement than most. Retirement taxes don't go away, they just change. Between required minimum distributions, Social Security taxes, capital gains, Medicare surcharges, and poor withdrawal timing, the average retiree can find themselves in a higher tax bracket than they expected with fewer strategies available to fix it. Wealthy retirees don't leave this to chance. They work with professionals to build a long-term, flexible tax plan that's aligned with their lifestyle, their income needs, and their future goals. And today, I'm going to walk you through exactly what they do differently so you can avoid the traps and take advantage of the opportunities that are hiding in plain sight. Hi, if you're new here, my name is Joshua Bliss, founder of Gateway Capital Management, now proudly aligned under Balboa Wealth Partners. I've been helping successful professionals, retirees, and business owners navigate retirement for over 19 years. And one thing I've learned is this: it's not just about building wealth, it's about protecting it from unnecessary erosion, especially when it comes to taxes. Because while most retirees just focus on the stock market, smart retirees focus on what they can actually keep. Let's break down what wealthy retirees do differently so you can start doing the same. Number one, they don't wait until retirement to start tax planning. This is hands down one of the biggest differences between average retirees and wealthy ones. Most people think of taxes as something to deal with after they stop working, but by then, many of the best opportunities are already off the table. Wealthy retirees know that the most effective tax planning happens before you retire, sometimes 5, even 10 years in advance. They don't just focus on how much they're saving, they're thinking about how that money will be taxed when they eventually use it. And that's where the concept of tax diversification comes in. Here's what that looks like in practice. They spread their savings across 3 major tax brackets. Tax deferred accounts, like traditional IRAs and 401ks, which gives you a break now, but will be taxed later as ordinary income. Taxable brokerage accounts, where growth is subject to capital gains tax, but it also gives you more flexibility. And lastly, tax-free accounts like Roth IRAs or health savings accounts, where you pay taxes upfront but never again on the growth or withdrawals as long as the rules are followed. By filling these buckets before they retire, they can give themselves options later, such as in high-income years, they might live from a Roth. In low-income years, they might convert traditional accounts into Roth. And they can time their capital gains from their brokerage accounts around their tax bracket. And that's just the start. They also think about whether they have a gap between retirement and Social Security, how required minimum distributions will affect their future income, what their ideal tax bracket really is in retirement, not just today, but 5, 10, or 15 years from now. The takeaway here, tax planning is not a one-time event. It's an ongoing strategy that works best when you start before you need the money. Wealthy retirees don't just hope it all works out, they map it out in advance, year by year, so they can retire with more control, fewer surprises, and potentially significant tax saving over time. 2, they understand tax bracket management. One of the most overlooked aspects of retirement planning isn't just how much income you'll have, it's how that income stacks up against the tax bracket. Most people assume I'll be in a lower tax bracket when I retire. And while that might be true for some, for many successful savers and high earners, it's actually the opposite. Here's why. During your working years, your income comes from your job. But in retirement, you could have income from a variety of sources, such as required minimum distributions or RMDs from traditional IRAs or 401k. You could have income coming from Social Security or dividends and interest from brokerage accounts, capital gains, possibly even a pension or rental property income. Add that all up and you may find yourself in the same or even higher tax bracket than when you were working, especially once RMDs began at age 73. And here's where it gets tricky. Once RMDs hit, you lose control over how much is coming out of your account. You're forced to withdraw a minimum amount every year, whether you need it or or not. And those withdrawals are taxed as ordinary income. That is why wealthy retirees practice tax bracket management. They just don't look at this year. They look at the next 10 to 20 years and ask, where's my income coming from in each stage of retirement? How much room do I have in my current tax bracket? Should I realize some income now on purpose at a lower rate? How can I reduce the size of future RMDs? Let's take an example. Let's say you're retired at age 60, not collecting Social Security yet, and have very minimal income. You might be in the 12 or even 10% federal tax bracket, but that window won't last long. Now, a wealthy retiree may use that window to convert traditional IRA dollars into a Roth IRA up to the top of that low bracket. They may harvest capital gain in a taxable account while they're still in the 0 or 15% long-term capital gains bracket. They may realize income now to avoid triggering IRMAA, which is Medicare surcharges. They may smooth out taxable income to avoid spikes later in retirement. They understand that the tax code is progressive and that you don't need to avoid all taxes to win. You just need to be strategic about how much you recognize and when. Because if you can fill up the lower tax brackets now, you reduce the chances of falling into the higher ones later. It's a gaming of timing and control. And that's why wealthy retirees and those who work with proactive advisors often pay less in taxes over the course of retirement than those who don't plan at all. Number 3, they use Roth accounts strategically. Wealthy retirees love Roth IRAs, and not just because of the tax-free growth. Here's why. In a Roth IRA, there are no required minimum distributions. Withdrawals don't affect Social Security taxation. Income doesn't trigger IRMAA surcharges. Roths are powerful legacy tools for passing wealth tax-free. But here's the catch. You can't contribute to a Roth IRA once you're over the income limit or retired without earned income. That's why high-income retirees often use strategies like backdoor Roth contributions, Roth 401ks while they're still working, Roth conversions in the years between retirement and age 73. They don't wait until the RMDs hit like a tax bomb. They convert slowly, intentionally, and with long-term tax lens. 4, they pay attention to where income comes from. Not all income is taxed the same. Traditional IRA, 401k withdrawals are taxed as ordinary income, whereas Social Security can be taxed up to 85% depending on your income. Capital gains from brokerage accounts are taxed at lower rates, sometimes even 0%. Roth IRA withdrawals are completely tax-free. Annuity income could be partly or fully taxable depending on the structure. Wealthy retirees know which accounts to pull from and when based off their income targets and tax bracket in that specific year. They also often coordinate with their advisor and CPA to review annual income, expenses, and tax projections, not just set it and forget it. Number 5, they plan for the tax torpedo. This one hits a lot of people by surprise. It happens when IRA withdrawals plus Social Security plus investment income push you over a certain income threshold, triggering taxes on your Social Security and higher Medicare premium. Wealthy retirees get ahead of this. They structure income to keep provisional income below taxation threshold. They use Roth withdrawals and basis from brokerage accounts, non-taxable. They avoid triggering IRMAA surcharges that increase Medicare premiums by thousands of dollars per year. In other words, they don't just look at what they're spending, they look at where the money is coming from and how that affects everything else. 6, they know when to give. Charitable giving is a major part of many retirees' lives, but the wealthy give strategically, not emotionally. Here's how. Qualified charitable distribution, also known as QCDs. These are direct IRA distributions to charity, which satisfy RMD and avoids income tax. Donor-advised funds bunch several years of giving into one tax year to maximize tax deductions. Appreciated asset. Donate stocks or investments instead of cash to avoid capital gain. They use giving not only to make an impact, but to reduce taxable income and manage their overall tax picture. Number 7, they work with professionals proactively. Here's the final point. The wealthy don't try to navigate all of this on their own. They review taxes annually, not just in April. April. They run multi-year income and tax projections. They adjust withdrawal based on upcoming tax changes or threshold. And they collaborate with an advisor and tax professional to avoid missteps. The takeaway: wealthy retirees don't wing it. They have a clear strategy that's flexible, proactive, and built around one goal: keep more of what they've worked so hard to build. If you're 5 to 10 years away from retirement or already retired and unsure if your tax strategy is working for you, now is the time to act. Book a call with me using the link in the description below. We'll walk through where your income will come from, what your future tax brackets look like, and how to better align your accounts, income sources, and withdrawal strategy. Retirement isn't just about what you save, it's about what you keep and how long it lasts. Let's make sure your plan is working as hard as you did to build it.